Two investors start with the exact same amount of cash. One puts every dollar into the stock market and never touches it again. The other uses that same cash as a down payment, borrows the rest from a bank, and buys a rental property instead. On paper, they made completely different bets. In reality, they just answered the same underlying question two different ways, and almost nobody in the personal finance world agrees on which answer is actually correct. Real estate agents will tell you property always wins. Financial advisors will tell you the stock market always wins. Both of them are quoting real statistics. Both of them are also being deeply selective about which statistics they show you. So today, we're doing a version of this comparison neither side actually wants to give you the full math, including the parts that are inconvenient for whichever side you're already rooting for. Let's get into it. Start with the raw numbers, stripped down to their simplest form, because this is where the debate usually begins and where most videos on this topic stop entirely. Over the long run, the S&P 500 has delivered an average annual return of roughly 10.5%, including dividends. Over that same long stretch of time, U.S. residential real estate, measured purely on price appreciation, has grown at somewhere between 3.8% and 4.5% a year. Judged only on that comparison, stocks aren't just winning. They're not particularly close. And if this video ended right here, stocks win would be a completely fair conclusion. But that comparison is also deeply incomplete, and here's exactly why. It compares apples to a completely different fruit. The stock number represents total return. The real estate number represents only price appreciation. It doesn't include rental income, and critically, it doesn't include the one variable that changes this entire conversation. Leveraged. Here's what that actually looks like with real numbers. Say you have $50,000 to invest. Put it entirely into the stock market at that 10.5% average return, and in 1 year, you made about $5,250. Straightforward. Now take that same $50,000 and use it as a 25% down payment on a $200,000 rental property, borrowing the remaining $150,000 from a bank. If that property appreciates just 5% in a year, modest, unremarkable growth, that's $10,000 in appreciation. Add in, say, $4,000 of net rental income after expenses, and your total return for the year is $14,000. On the same $50,000 you started with, $5, $250 versus $14,000. Same starting capital. The difference isn't that real estate secretly grows faster than stocks. It's that the bank let you control an asset worth 4 times what you actually put in, and every dollar of appreciation on the entire $200,000 property belongs to you, not the bank. This is the single most important concept in this entire comparison, and it's the exact reason so many real estate investors insist property outperforms the market. Return on equity, not return on the underlying asset, is the number that actually determines your personal wealth. Now, before this starts sounding like real estate is simply the obvious winner, here's the necessary counterweight, because leverage is a double-edged sword, and pretending otherwise would make this video dishonest. When real estate values fall, leverage doesn't disappear. It flips against you with the exact same intensity it worked for you. Drop that same $200,000 property by 10%, and you haven't lost 10% of your money. You've lost 40% of your $50,000 down payment, because the loss is measured against your equity, not the full property value. Leverage amplifies gains and losses with total indifference to which direction the market happens to move. Stocks can technically be leveraged too, through margin, but almost no long-term investor builds their core strategy around it, because unlike a 30-year fixed mortgage, margin can be called in during a downturn, forcing a sale at the worst possible moment. Real estate's version of leverage is slower, more stable, and far more forgiving of a bad year. That structural difference matters enormously, and it's a real, measurable advantage. Not just a personal preference. Let's talk about the return real estate produces, including everything. Appreciation and rental income combined, unleveraged. Current estimates put that total return somewhere around 8% to 9% a year. Add leverage back into a well-selected property in a strong rental market, and total return on equity climbs to somewhere between 15% and 25% a year, with some well-run leverage deals reaching roughly 3 times the return of an equivalent unleveraged stock position. That's not a fringe claim from a real estate salesperson. That's what the after-leverage math actually produces when the deal is underwritten conservatively and the property performs as expected. Now here's where taxes enter the conversation, because this is a category where real estate has genuine structural advantages the stock market simply doesn't offer. Rental property owners can deduct mortgage interest, depreciation, maintenance, and a range of operating expenses directly against their rental income, sometimes reducing taxable income to nearly zero even on a profitable property. There's also the 1031 exchange, a specific tax provision that allows real estate investors to sell one property and roll the full proceeds into another, deferring capital gains taxes potentially for decades. Stocks held in a normal brokerage account get no equivalent mechanism. Gains are taxed when you sell, full stop. So far, this might sound like real estate is quietly winning on every front once you dig past the surface level number. Here's where the picture evens back out, because everything covered so far has ignored risk, effort, and one asset class's single biggest advantage: liquidity. You can sell stock in an S&P 500 index fund in seconds during market hours for the exact price quoted on the screen, with essentially no negotiation and no buyer to find. Selling a rental property, by contrast, can take weeks or months, involves inspections, negotiations, agent commissions typically running 5% to 6% of the sale price, and a buyer who has to actually want that specific property in that specific condition at that specific price. If you need cash urgently, real estate is, functionally, one of the least liquid major asset classes available to an individual investor. There's also the management burden, which real estate advocates sometimes gloss over entirely. A stock portfolio doesn't call you at 11 p.m. because a pipe burst. It doesn't skip a payment because it lost its job. It doesn't leave holes in the wall when it moves out. Rental property is, in the most literal sense, an active business. Tenant screening, maintenance coordination, vacancy periods, and the ongoing risk that a single bad tenant can erase a year of returns in legal fees and property damage. Real estate's higher return on equity isn't free money. Part of what you're being paid for is exactly this: hands-on labor and operational risk that a stock portfolio simply doesn't require. For people who want real estate exposure without any of that operational burden, there's a middle path worth knowing about. REITs, real estate investment trusts, which trade on the stock market exactly like a stock but hold portfolios of actual income-producing properties. REITs have historically returned somewhere around 10% to 12% annually over the past 3 decades, capturing much of real estate's underlying performance with full stock market liquidity, professional management, and none of the 11 p.m. phone calls. The trade-off is that you also lose real estate's core superpower. You can't apply your own personal leverage to a REIT the way you can to a property you finance directly. Now let's zoom all the way out past any single country's housing market or stock exchange, because this comparison has actually been studied at a genuinely global, multi-generational scale. A landmark academic study, the rate of return on everything, analyzed total returns across 16 advanced economies going all the way back to 1870, covering nearly a century and a half of data, multiple wars, multiple depressions, and every kind of market environment in between. The finding, globally, housing and equities have produced almost identical long-run real returns, averaging close to 7% a year each. But housing achieved that same return with meaningfully less volatility than stocks, smaller swings, fewer violent crashes, a steadier ride to roughly the same destination. That single finding, replicated across 16 different countries and 145 years of history, might be the single most important data point in this entire debate, over long enough time horizons. This isn't really a contest between a winner and a loser. It's a genuine trade-off between 2 different paths to a similar long-run destination. One smoother and slower feeling, one more volatile but more liquid and far less demanding of your time. Here's the honest answer. Because a topic like this deserves one instead of a dramatic winner declared for the sake of a good title. If you want the highest possible return on the capital you put in, and you're willing to trade time, liquidity, and hands-on effort for it, leveraged real estate, bought carefully in a market with real rental demand, has a legitimate, well-documented mathematical edge through leverage alone. If you want strong long-term growth with minimal effort, full liquidity, and the ability to access your money within seconds if life demands it, the stock market, or REITs if you still want real estate exposure, is very hard to beat. And here's the detail almost nobody says out loud in this debate. Most people who actually build substantial wealth over a lifetime don't pick a side. They hold both, using the stock market's liquidity and simplicity as the foundation, and real estate's leverage and tax advantages as an accelerant, layered in once they have enough capital and enough life stability to take on an asset that demands real, ongoing attention. The question this video was actually built to answer isn't which is better in the abstract. It's which trade-off actually fits your life right now. Your available time, your tolerance for a 3 a.m. phone call, and how much liquidity you genuinely need access to if things go wrong. Tell me honestly in the comments. Are you a stocks person, a real estate person, or genuinely torn between both? I want to see exactly where this community actually lands on this. If this gave you the full picture instead of just one side's favorite statistic, subscribe, because next week we're running an actual side-by-side 20-year projection with real numbers, so you can see exactly how both paths compound from wherever you're starting today. See you in the next one.